Hello and welcome to this update on the European elections, a vote crucial for the future of the EU in the context of rising populism. The main risk for markets was an important surge in support for anti-establishment parties, and it did not materialize. At around 25%, Eurosceptic parties will remain in the minority, unable to considerably impact the legislative agenda or the appointment process for key positions, and their share of seats could even drop if the Brexit Party MEPs don't serve a full term. Meanwhile, pro-EU parties managed to hold their grounds, with notable surprises from the Green and Liberal blocs, supported by a record increase in turnout. Dominant until now, the traditional centre-right and centre-left parties lost their majority, with a share of votes shifting to the smaller pro-EU parties. First, the legislative continuity is more or less maintained, despite a more fragmented pro-EU majority. Second, on a global scale, the balance of economic powers is preserved as well, as a united European Union stays one of the three main economic blocs, together with the US and China. This is all the more important for investors in a period of escalating trade tensions. Besides, the EU's position in the world's economy makes the state of global trade vital for its recovery. Now that the European elections risk has largely dissipated, Brexit, but more importantly, the US-China dispute will dominate market attention. Let's now turn to Stéphane for more on how these risk events shape our investment scenarios.
As Samy described, the European elections were a test of strength for populist forces. They also highlighted the need for a united, long-term vision for the European political project. The impact on markets, however, remained limited since national governments hold most of the power in the European Union. Next on investors' agenda are Brexit and global trade tensions. The Brexit Party's success in the EU elections emphasized the country's divisiveness over Brexit and voter discontent with UK politics. We believe the near-term downside risks to sterling have increased after Theresa May's resignation, as the Brexit Party's victory might lead the Conservative to elect a hardliner Brexiteer as the next Prime Minister. This raises the prospect of a disruptive outcome where the UK could crash out of the EU without a deal, leading to increased hard Brexit risk premia and more uncertainty for sterling assets. Our main scenario remains, however, a smooth resolution, as the UK has no other logical choice than to stay as close as possible to its main trading partner. Turning to emerging markets, while Indonesia, South Africa and India all handed their re-elected leaders mandates for continued reforms, US-China trade tensions trump the positive macroeconomic fundamentals. We expect an eventual deal between the US and China, even though the negotiation process now looks slower than anticipated. We see the probability of a deal in June at about 40%, with the same odds for a deal being postponed to later in 2019. Finally, the chances of a breakdown in negotiations, which would raise the prospect of a severe slowdown, stand at about 20%. With protracted trade negotiations, we expect the US dollar to trade in a range between 111 and 113 versus the euro. As we go into the summer months, we continue to advocate a prudent portfolio positioning. The latest developments have supported our risk reduction strategy and the slightly defensive emerging equity positioning. They have also stressed the need for portfolio protection in the form of option strategies and safe haven assets, such as gold and the Japanese yen. Our next investment strategy update will be out in a few weeks. Until then, we thank you very much for watching.